Are you interested in investing in real estate but want to do it more passively without having to deal with tenants, toilets, or vacancies? I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Today on The Real Wealth Show, we'll be talking about more passive investments like syndications. I'm bringing in Mauricio Rauld, who is a seasoned real estate lawyer who specializes in syndications. He's the owner of Platinum Legal Consulting. Mauricio is going to help us understand what syndications are, how deals are structured, and why so many people want more passive investments. Mauricio, welcome to The Real Wealth Show.
Well, thanks for having me, Kathy. Always great to see you.
Always great to see you too. And I just want to go back to basics. We've had you on The Real Wealth Show many times, and sometimes we go deep into complicated topics. And today I just want to start with the basics, like what is a syndication?
Yeah, let's do it. So a syndication is literally just the pooling of resources, right? Usually it's cash, right? So people or somebody's pooling cash in order to go buy something. Now, in our world, that something is usually real estate, but it can be something as simple as, hey, I want to go buy a single family residence. I have 3 or 4 buddies of mine, and so I go talk to them. I pool the money from those 3 or 4 people, and then I go do the deal, and then we split the profits, 4 ways or 5 ways. So my buddies, my investors are actually putting up all the money. I'm putting all the sweat equity, the hard work, the knowledge, the expertise, and we acquire a property and we split the profits, 4 or 5 ways. That's kind of a simple, straightforward syndication, because a lot of people, as you know, Kathy, they have money, right? But they don't have the expertise, they don't have the time, they don't have the inclination, they don't really know much about it, but they're busy doing their W-2 work or whatever they're doing that they're really great at. But they want to invest in real estate, but they don't know how to do it, and they don't really want to go spend the time. It takes time to learn, and a lot of people don't want to. So syndication allows one or more people, which we call sponsors, to aggregate other people's capital to go buy something, usually real estate in our world.
And let's talk about the difference between a JV and a syndication, because someone listening to you right now might be thinking, oh yeah, I found a property, I had mom and dad invest in it, and a cousin and the neighbor. How is that different than syndication?
Yeah, it's probably one of the biggest mistakes out there in terms of when people are out there raising capital is thinking that, hey, this is a joint venture, or I'm going to call it a joint venture, and therefore I'm good, right? I don't have to comply with all these laws.
Yeah.
And that's just not the case. I mean, it doesn't matter what you call it, whether something's a joint venture or a syndication, or what a syndication really is, the securities offering, and we'll say why in a second. But whether it's a joint venture or a syndication, you don't get to make that decision. That decision is made by the regulators, which is typically the SEC, the Securities and Exchange Commission, or maybe even your state regulator. So just calling something a joint venture doesn't matter. In order for something to be a true joint venture, what has to happen is that everybody involved in that venture has to be actively involved in the project. Everybody has to be not only contributing capital, maybe contributing credit, but also they're rolling up their sleeves and they're doing something, right? So the returns of the project are not generated by 1 or 2 people. In the case of a syndication, the returns are generated by everybody's effort. Everybody's in there doing their thing. Even when it comes to sort of vernacular, I don't like it when even on joint ventures, you don't really have investors in a joint venture. You have partners, right? You have business partners. It's very similar to you're basically starting a business. You're going to have less than 5 people. And once you get to more than 5 or 6 people, it's very difficult to argue that that's a joint venture. But you have business partners, and these are ventures, and everybody has some knowledge of whatever asset class you're acquiring. So if it's this real estate, everybody has real estate expertise, and literally everybody's rolling up their sleeves and actively involved in the deal, because that's what's going to get you around the definition of a security. And let's talk about that really quickly, because that'll sort of let you know, hey, this is a security, this is a joint venture. A security, quite simply, is anytime you're taking money from passive investors where the returns are generated by your efforts, meaning you're doing all the work and the investors are just giving you a check and then going home. that's a security. It doesn't matter how you structure it. It can be in the form of an LLC. It can be pretending to be a joint venture. It can be a profit sharing agreement. It could be a side contract. It can be a tenants in common agreement. Like, the structure doesn't matter. If somebody's there that's generating the returns and there are other people that are just writing you a check as a passive investor, that's a security. So a joint venture just has to be the opposite. Everybody has to be involved.
Okay, so you get grandma, you get your mom and your aunt. You better give them a shovel, right? Give them a paintbrush.
They've got to do something, because if and again, I'm never here to tell you, yeah, hey, what are the odds of you getting caught, or what are the odds of something happening, right? That's not my job. But and maybe some people argue, look, it's my parents. What are the odds that my parents are going to, if I lose money and my parents are upset, are they really going to sue me? They're my parents. I'm like, well, I don't know, but technically they could. There is no father, son, or mother, daughter. There's no family exemption.
For that.
Yeah, there's no family exemption. So if you raise money from your uncle, your aunt, or your brother, and the deal goes south and they're not happy about it and they want their money back and they want to, pursue, the court system or sue you, they can. There is no exemption. Oh, wait a minute, you were my close friend, and so you knew what was going on. You don't have recourse. There is no specific exemption for family members or close friends.
Yeah, I mean, I see it right now with two neighbors who now are not speaking to each other for this very purpose. Oh, let's do a deal together, and one person's doing all the work, the other's giving the money. It didn't go as planned, and there's a lawsuit. It's very unfortunate. So that's why I wanted to bring that up. Basically, it's smaller deals where you wouldn't want to go through all the process of what it takes to do a syndication, figure out, get an attorney like Mauricio, get everything in writing, make sure it's legal if you're taking anyone's money. Anyone's, okay? Make it super clear. Mauricio, I see it all the time. That, yeah, you too.
It happens a lot, especially in the smaller deals. And I get it too. It's like, I'm not here to say, oh my God, you need to hire me or a lawyer or something. I mean, the reality is a lot of times, even in the example I gave you, I'm like, even if you're buying let's just say you're actually buying a significant asset. Maybe you're buying $1 million home. Like, let's say it's an Airbnb or a VRBO. It's $1 million residence, but I'm going to get a loan on it. So I only need 20% for the down payment. I only need $200,000. It doesn't make sense to do a syndication for $200,000 because the compliance costs, the hiring of the attorney, the hiring at that point, you probably need to hire a real estate attorney to make sure your investors are protected. The cost will, it'll cost you 10, 15, 20 grand. And if you're only raising 200,000, that's a big percentage of it. That's a dilemma that a lot of people face. It's like, it doesn't make sense for me to go hire a securities attorney, but on the other hand, you are selling securities. And so we get that dilemma, which we haven't really figured out a solution for, but it's a gap that exists in the marketplace. And unfortunately, too many are just going the route of, hey, I'm just not going to comply, or I didn't know I had to comply, and they go do it. Quick story, Kathy, like I was with a friend of mine over the weekend, and some of my old friends, they started a wine company. Okay, so not real estate, but they started a wine company, raised money from a bunch of people, including my friend. They consulted a startup attorney. Right. And the attorney they're not securities attorney, right? So they didn't know. And so they didn't comply with any. They were literally raising, I don't know if it's millions, but they're getting $50,000, $100,000 checks from people to invest in their wine business. And they don't know anything about securities. They don't know anything, they haven't checked with anyone. And so it's just a very common problem.
Yeah, I see this. Just because an attorney is an attorney doesn't mean they're an expert in everything attorney or everything legal. So, always get a securities attorney if you're taking money from anyone. Otherwise, make sure everybody's working so that it's a true JV. Okay, so if you are getting something bigger than, just we're flipping a house together or, something like that. If you're like us at Real Wealth, we have a build to rent community. It is $3 million that, over $3 million we're raising for this project. That's a lot bigger than 200,000.
Yes.
And we're building duplexes in San Antonio. So that's a whole nother deal. So let's talk about how a syndication like that is different from a JV.
Yeah. So in a scenario, let's use your exact example. So you've got Real Wealth, or the company that we created for Real Wealth. So let's just say Kathy for ease. So Kathy wants to go acquire, has a great business plan, wants to go acquire all this land and develop these built to rents, but it requires $3 million. Kathy doesn't have $3 million or doesn't want to put all those $3 million into it. And so she wants to share the wealth because it's Real Wealth. She wants to bring in past investors who are too busy with their jobs or don't have the expertise to go figure out what's a good market, or like how to develop things, how to market something, how to put a plan together. And so you go out to the marketplace and you raise that $3 million from mostly it's individual investors, and those could be $50,000 chunks, $100,000 chunks, whatever the agreement is. And you raise that from passive investors, where the passive investors will not be doing any work. They will not be involved day to day to the project. They will be updated on what's going on, but essentially they have looked at the business plan. They've looked at Kathy, like looked at Real Wealth. They know that they have a great track record. They know they've been doing all this great work. They know what they're doing much more than the investors themselves. And so they then write a check for 50, 100,000, whatever the amount is. And you then get to take that $3 million and go purchase the land, get all the development costs, and actually create this project that's going to generate a return. And those returns are then split with those investors, right? The investors actually get the vast majority of those profits, and then Real Wealth and Kathy will get a percentage of that, sort of what we call sweat equity, for doing all the work, for rolling up the sleeves and generating that profit. Then Real Wealth gets a percentage of the profits, but the investors put up all the money. Real Wealth does all the work, and then there's a profit split, which is just agreed upon between the investors and the sponsors, which is what the vernacular that we use is Real Wealth in this case would be a sponsor or a GP, a general partner. Those are kind of the two interchangeable words that we use.
So I like to compare it to the driver of the bus and the passengers on the bus. Right. You get on a bus because you have a pretty good idea where that bus is headed. Right. And you're not planning on driving it. You're planning on going on for the ride, but you have hopefully enough information on where that's going that you know if you want to get on that bus or not. So the driver of the bus is the GP, the general partner of the LLC. And maybe there's two drivers, maybe there's three. You got to be careful about how many drivers there are, because that could be a problem.
Yeah, we don't want too many. And it's almost, I love that analogy. The airplane's another good one, because with the bus, sometimes people are like, well, I could go drive the bus if for whatever reason, I don't know how to fly an airplane. And most of these investors don't know how to identify a good deal, how to get into contract with the property, how to negotiate the contracts, how to build something, put a plan together, marketing plan, and actually generate a result. And so that's a great analogy.
I'll take the airplane one, because you do have two pilots oftentimes.
Yeah, and you don't want 17 pilots, right? That's another thing. It's like you may have two pilots, maybe a third one in the back just in case, something happens or they're along for the ride. But one of the biggest issues I've had over the years is I've just seen syndications where you have literally 8, 9, 10, 12 sponsors or GPs. And then the question always comes up, which is, what in the world are they doing? Like, you don't.
Who's in charge? Yeah.
Yeah. Who's really in charge? Number one. Yeah. And what are these people doing? Because we don't need 12 people. Even if it's a complicated deal, you might need 3 or 4. If it's a large, complicated, maybe you need somebody boots on the ground. Like, hey, let's have somebody locally in San Antonio to kind of be the boots on the ground, or let's have somebody who's an expert in that area. But after 3 or 4 max, what's everybody else doing? Why do we need to bring in 8 other people after we've got our core team?
Yeah. Okay. So the GP, the people running the deal, the LP, the limited partners, are the passengers on this flight. They know where they're going. They have a good idea. Now, anything can happen along the way that might be out of control of the pilots who are running that flight. But what does it take to get on that plane as a passenger? So to become an investor in a syndication, there's qualification for that. So a lot of people are surprised.
There's qualifications, and it will depend on what road or what flight plan the sponsor wants to take, right? Because there's different ways to get there, right? And depending on which path, let's call it the road, depending which road we pick will dictate the type of qualifications that the investor will have. So, for example, because we're selling securities, because Real Wealth is selling securities, we either have to register the security with the SEC or we have to find an exemption. And depending on what exemption we use, what road or avenue or flight plan we pick will dictate what type of investors we can take. In a 506B offering, you can take accredited investors and a limited number of non-accredited investors. So accredited investor is someone who has $1 million in net worth, excluding their primary residence. Otherwise, everybody in California would be accredited, or has earned $200,000 a year in income and has a reasonable expectation of earning that this year. And if you're combining it with your spouse, that's $300,000. That's what an accredited investor is. Some flight paths only allow you to take accredited investors. So where there's an exemption, for example, called 506C, that's as technical as we're going to get, a 506C exemption only allows sponsors to bring on accredited investors. So you have to meet those financial requirements, or there's a couple other ways to do it. But with the 506B, which is what a lot of people start with, This allows people to take a limited number of non-accredited investors, specifically 35, as long as they're sophisticated. There's still a level of sophistication that the investor needs to meet. They have to have enough knowledge and experience in financial and business matters in order to be able to evaluate the risks and the merits of your particular investment. So they have to have that level of sophistication. But sometimes they have to also be accredited, but sometimes they don't. It just depends on what flight path we file.
There are different, I guess, would you say, there's different oversight between the two because the SEC is really wanting to protect the non-accredited investors.
Yes.
A lot of people don't understand accredited does not mean that you took a class. It just means
Correct.
that you have a certain net worth or you make a certain amount of money. And I'm assuming that's because the SEC isn't worried about people with money. It's like, hey, you should be able to afford an attorney or a CPA to look through these documents versus grandma who's putting her last dollar because she wants to help so-and-so might not, be able to live without that money if it gets lost. Is that right?
Yeah. So this is a debate that's gone on for as long as this thing has been on the books since 1982. But yes, the government assumes, which I will say is incorrect, but it makes the assumption that somebody who's accredited, who's high net worth or has high income, they're smart. They don't need the level of protection from the government. They can withstand the loss. And so we don't worry so much. And the requirements that we have for those investors are not as high as we do with non-accredited. Now, we all know that's a bunch of BS because we all know that there are some of the smartest people in the world and they have modest means. And then we have people who have more money than we'll ever see. And they're the dumbest people in the room. So there's not a really direct correlation. So there's been this debate as to whether we should add something else. But yes, if you have an accredited investor, the government assumes you're a big boy, big girl. We don't need to protect you as long as we just don't commit fraud with you and don't completely misrepresent things. They should know enough to ask the right questions and we don't need to protect them. Non-accredited is the opposite. Non-accredited is the government assumes you don't know anything. You need all these consumer protections. You are the dumbest person in the room. And if I don't tell you every single little thing about the deal, you're not going to be able to make a decision. And so there's what we call disclosure requirements for non-accrediteds that are very, very, very detailed. Essentially, there's a document out there, which we can get to in a second. There's a document called the Private Placement Memorandum, which is a document where you literally have to disclose every single detail about your deal, all the possible ways your deal can go wrong, all the information about the sponsor. I'm exaggerating, saying, where do they go to kindergarten, but literally very detailed information about the sponsors. And it's just a document that provides all of these disclosures. And that's really the costly part of, at least on the legal side, is you need a securities attorney to figure out what are all the things that need to go into this document. And we need somebody to prepare those disclosure documents to present to the investors prior to them investing in a particular deal if they're non-accredited.
So for the sponsor, for the GP, the driver, it is more risky to bring in non-accredited investors, right? Because
yes, I would agree with that. Yes, because the burden is, literally, I mean, and again, let me backtrack a little bit. It's not necessarily the investor that's going to come out. Think of it, if you're even worried about, hey, this is my friend, it's not the investor, it's the plaintiff's lawyer that they're going to hire down the road that's going to be bringing up all these issues. But like a good plaintiff's lawyer will literally, with a non-accredited investor, say, look, you didn't disclose this. And maybe it had nothing to do with what was going on, but the argument would be like, if you had disclosed this, Kathy, there's no way my client would have invested and they wouldn't have lost money. And so you have this obligation to literally think of every single, even if it's unlikely that it will go wrong. Great example. I tell the story of the oral surgeon because I have terrible teeth. You've seen them, Kathy. I've had so many oral surgeries. I have so many oral surgeries. So I go to get like wisdom teeth out or a tooth pulled, and the dentist gives me this medical consent form, that yellow sheet, and it tells me all of the risks from this procedure that I'm going to be under for like literally 2.5 minutes. But it's like, hey, look, we're going to take this thing out. You could get an infection. You can get some bleeding. You could die from being under. I mean, that is literally a 1 in a million shot, but there's a risk of death when you go under and take your wisdom teeth out. They lay out all the risks. I review. I sign the medical consent form. The dentist, the doctor then goes ahead and countersigns it. And then boom, they go ahead and do the surgery. That's what this disclosure document is. It's just a document where we can disclose every single possible way you can lose money. It's a very scary document, because obviously we're not intending to lose money. We think it's a really good deal, but we have to disclose all the ways the deal can go south. The investor reviews it. And the idea is that they now have all the information needed. So they're going into the investment with eyes wide open. They were able to make an intelligent decision whether this was a good investment for them or not. You've provided them with all the information. And as long as you've done that, you're going to be good from a securities compliance standpoint. The issues arise when you don't do that, when you fail to disclose something that was material, something that was important, or maybe you left something out that was really important that had you, by leaving it out, it made everything kind of misleading. That's where people get into trouble, or some people just flat out don't even prepare a private placement memorandum and don't provide the disclosure. So that's another way to get into trouble. But the name of the game here is disclose, disclose, disclose. As you know, having known me for many, many decades now, Kathy, I over disclose. I mean, I always say you can do almost anything you want as a sponsor, as the pilot of that plane. You can go wherever you want. You can almost do whatever you want as long as we've disclosed it. So all the passengers on that bus or on that plane know exactly where they're going, know exactly what the risks are, and they can then make their own decision whether this is a risk that they're willing to take on based on their personal circumstances.
Oh, and as the sponsor, those are hard things, and I kind of look at you like, really? If a meteor lands on we have to put this in here? But
the Martians are coming, Kathy. Don't you know that?
I mean, every possible risk is in there, and it does freak some people out. But more experienced investors just know that's you said.
It is what it is.
Same thing. You go to the doctor, you're going to have to sign something similar.
Yeah.
Same thing with selling a house. Oh my goodness, just disclose everything. On a condo that we sold, I knew there were issues because I had been on the HOA board. And I'm telling you, I probably wrote 3 or 4 pages of what was wrong with that place. And it's still sold, but then you're safe. If you don't put it on there, they can come back after you. At least, if you knew about it.
Yeah.
Yeah. We've kind of defined who can invest and who can do a deal. I mean, literally anyone could do a deal. And it's interesting. There's several different kinds of syndications. Some are, kind of more open-ended, like, hey, we're going from San Francisco to Phoenix. And another one might be like, we don't know where we're going. We're just going to go wherever we go. I've literally seen funds that don't really tell you what they're going to buy or what they're investing in. They just say, this is the return we're expecting. And maybe those work sometimes, but man, that seems really risky.
They definitely work, especially if they're well known, and I'm going to give an example of somebody very well. I won't give his name out, but he's a really well known syndicator in the mobile home park space. And because he's well known, because everybody knows him, everybody feels like they know, like, and trust him. The pitch is literally, this is really, I mean, it's a little bit more pages, but essentially what it says is the plan is we are going to take your money and we are going to buy mobile home parks in the United States. That's what we're doing. There's no details as to where in the United States or what size mobile home parks, or are they stabilized, or are they, deprived? Like, it is very, very broad. And again, if you are a Grant Cardone, who I do not represent, but if you are a Grant Cardone or somebody really well known, you might be able to get away with that. For the rest of us, though, we tend to be a little bit more detailed, even if it's a fund where we don't know exactly what we're buying. So we may not know, on your airplane example, we may not know exactly where we're going, but we know we're going to Europe, right? I know that I'm not going to end up in Africa or Australia or South America because I want to go to Europe, and that's where we're going. I don't know exactly where we're going to land the plane, but somewhere in Europe, I've signed up for that, and we're good with that.
Okay, yeah. So if you are signing up for what is called a blind pool fund, which means you have no idea, just be careful. And because I've even seen that. There's so many capital raisers out there, and so many fund conferences and stuff, and people at those conferences, they're opening up funds and raising money, and they haven't been specific at all. They're just like, we're just going to go somewhere. Yeah. So be super clear. I totally agree with you. If I were investing with Ken McElroy in apartments, I really would not care about any more details than that, because his track record is so good.
Yes.
But otherwise, like in our syndications, it's like, we know we've already identified the land. This is what we're building. We've done it before. A lot of times it's just, we're super specific. Yeah.
What's great about, just to talk a bit about the differences, the nice thing about a project specific, so what you guys did in San Antonio are doing is a project specific deal. So what's nice about that is me as an investor coming in, I can look at your plan, and I can look more importantly at all of your assumptions for the plan. Like, these are the assumptions we're making, and I can criticize them, I can agree with them, I can disagree with them, I can maybe re-underwrite. So, well, I don't think you're going to be able to get that, but I think you maybe get even half of that or whatever, and I still can be comfortable. When it's a blind pool, I don't have any of that information. Like, I just have to literally trust the jockey, right? Who's the sponsor, who's putting that stuff together, and I have complete blind faith. I'm just going to write you a check. I know what you're going to go do. But even in project-specific syndications, which I am a passive investor, 80%, maybe even arguably 90% of your due diligence as a limited partner should be on the sponsor and figuring out what is their track record. Have they done this before? All of that stuff. And we want to get to a little bit later on, but underwriting or doing your due diligence on the sponsor is probably even more important if it's a blind fund. But make no mistake, it's super important also on project-specific deals.
Yeah, so using the plane analogy, I'm a pilot, but my co-pilot has built duplexes in San Antonio for years. And our members at Real Wealth have bought these, duplexes from them for years. Yes. We've seen how they rent. We know the property management. Like, we are so familiar with them, and they've done it so many times that, you wouldn't want me flying that plane, but with my co-pilot on board, we're good.
But also the plane, we want to make sure it's a great plane, that, hey, it's an American flight, or that has a reputation too. Like, you're the company, right? So the plane's important. I don't want to have some plane that somebody just built in their backyard yesterday and it hasn't been inspected, and I'm just going to go fly in that plane. Like, what plane I'm on is super important. And then also who the pilots are, and ultimately what's the destination? Do I know exactly where we're going? Is that really where I want to go? Or is it more like, hey, we're going to go wherever?
Yeah, exactly. Okay. So we structure our syndications pretty uniquely. I think maybe you could tell me, you've written up so many documents and you know how people structure things. On our build to rent fund in San Antonio, which is still open for investment, but just for a little bit longer, and it's almost sold out. If you're interested, you can go to realwealth.com/wildpine. But in our development projects, which we've been doing for 15 years, I didn't really have anyone like you. I didn't know you then. I didn't know how to structure things. And it just made sense that, I knew what the profits could be, and they're massive. And yet so often the investor just gets a 6% rate, and it's like, but I know there's lots of money here. Why are the people who are putting up the money getting such a low return? And I know there's reasons for that, but it just didn't make sense to me. So I just flipped it around and said, I'd rather have the investors have a high return, or at least a preferred return, meaning they get paid a certain amount before the sponsor does. So we upped it to, in the beginning, it was like 15% we were giving as a preferred return. And then on the split side, the back end profits, whatever left over, then the investors got a little bit less of that. And that's where the sponsors were incentivized. It's like, if you follow the plan, you get it done on time, investors get this bunch of money up front, and then the sponsors get their bunch at the end. We're down now to 12%. Our Wild Pine San Antonio project is a 12% preferred return, but still higher than most people. But the profit at the end is split 50-50. So how does that structure compare to what would be standard, or what you?
Yeah, that's a very high preferred return. So what's nice about a preferred, to your point, is that the investors get 100% of all the profits until they hit that percentage. It's not a guarantee, but if it's most people will use a 7 or 8%. So the idea is like, hey, you're going to get 100% of the profits until you get your 8% return based on how much you invested. Sometimes in some deals, you might have an 8% pref or preferred, but the project only generates 4%. And so you're going to get all of it, but you're going to end up with 4%. Again, that's why it's not a guarantee.
It's not an interest rate.
Yeah. Then the question becomes, hey, what happens with that difference? Does it roll over? And that's a different thing. So when you and I first started working together, I was like, wait a minute, your preferred returns are really, really out there. And so it's almost double sometimes. Well, now 12, maybe not quite as double, but they're out there, right? But then you do adjust it. So like, hey, let's instead of let's say most people will do maybe a 70 or 80% split with your investors that don't have a pref. So it makes sense, very common to have when you have a higher pref. I don't think I have any other clients that have prefs this high, to be honest with you. So I even have clients that will put together, 8 or 9, maybe 10% pref, and then maybe they'll go down to 50-50. But most people will just continue to to do the lower rate. So
And that's smarter, Mauricio. I mean, honestly, it's smarter because if the project gets delayed by unknown circumstances like COVID,
yeah,
then the sponsor's a little bit safer. I still and let me explain this. Like with a high pref like we give, if we get delayed by circumstances out of our control, we're the ones who pay the consequences of that, not the investor. The investor is still taking the cream of the top. They're getting all the profit until they get their 12%. We don't get anything. In the beginning, I wouldn't even charge fees. So we
right,
were basically working for free for 5 years, putting our own money in, hoping
yeah,
we get profit at the end. And sometimes we didn't. So it just cost
yeah.
me money. So now I've learned, we have to have overhead.
Yeah, you got to have some, because otherwise, I mean, you still want these. I mean, you want incentives aligned, right? So that's why I love the high pref, because obviously you get rewarded if you hit the project out of the park. But there's a minimum level of payment. You also want, as a limited partner, I want you figuratively to get up every morning and go work for my fund. Like, and if you're not getting paid or the deal's not going well and you don't have that incentive to go do and generate the return, so there's a give and take there. Like you want to make sure that they really get compensated, that's really aligned with the LP. So I love that model, but I'm glad you've now started to take some fees anyway, just to keep the lights on and have the team and everything, because people also want to be able to reach out to the team and have quick turnaround times and access and have some kind of an investor relations person. They want to have all that costs money, right? So you want to have some sort of a fee. Trust me, when you see these fees on there, the 2% asset management fee or whatever these fees are, people are not getting rich of those fees. Those are literally fees to keep the lights on, to have the payroll, to have the office, to have the infrastructure in there. Sponsors really don't get paid until the end of the project, when the project eventually sells or there's a huge refinance maybe at the end of the project. That's really when sponsors start getting paid. But when you start off, like the cash flow on the beginning, most of that gets eaten up and goes to the investors, as it should.
Yeah.
They're putting up all the risk.
Yeah. So it would be typical that if you're investing in a syndication, you would get a 6 to 8% preferred return.
Yep.
Sometimes there's none. There's no
Yep.
preferred return. It's just, hey, we're going to split the
Yep.
profits. But generally, and again, that means that usually you have to read the documents, but usually first money out is either going to pay your capital back first. That's how we do it. All funds first go to pay you and your capital back outside of the fees charged. Then this preferred return per year. So it's not total. Then this, you've got to also read your documents to make sure, am I getting 6% total? Or is it per year?
Right.
In our case, it is annualized. And then
does it roll over? All those things, right?
Yeah. So if it is really helpful to have someone review the documents before you sign anything, because the difference can be one word, like of or the. Is it the return of capital?
Yes.
Yeah. I mean,
Yes.
do you need somebody who loves detail to review these documents?
Yeah, and there's and I used to, when I started my career, do it, but I mean, I've seen lawyers out there for like literally probably anywhere from sometimes less than $1,000. They will review the docs, and what I would recommend, just a quick tidbit for this is the way I used to do it. What I would do is I would meet with the client ahead of time and hey, what is your understanding of the deal? And they would say, oh, I think it's an 8% pref, or this is how it works, and I've got these voting rights, and this is what we're doing. Cool. Then I would review the documents. And I would see, hey, this isn't quite exactly what they think it is, or hey, here are some potential red flags you look at. And then I would do a quick follow-up call with the clients and say, hey, here's the disconnect. Here are some of the risks you may want to think of, but I'm not there to tell you whether to invest in it. I'm just highlighting the potential risks, and as long as you're comfortable. So for $1,000, that to me makes a ton of sense, especially if you're investing a high dollar. If you're investing 50,000 or 100,000 or whatever, then it probably does make sense. That ounce of prevention does make sense, and there are securities lawyers that will do that for you.
Very good. So what's a typical timeline in a syndication?
Well, it all depends on, there's the legal timeline and there's the project timeline, right? So it depends on the type of project, right? If you're doing a development deal, that's going to probably take a little bit longer than if you're doing a project specific, if you're acquiring something like maybe a multifamily. But there's the process. Let's talk about just purely the syndication process, right? So the process usually becomes the syndicator in a real estate deal will get into contract to buy a building, right? Usually once the contract gets signed, they're going to have some period to close, and that's the time frame where they've got to start working with their lawyers to get all the things created. So number one, you're going to need a securities lawyer to make sure you're raising the capital compliantly. probably need a real estate attorney to make sure all the real estate part, the contract is probably done, all the pulling all the title and the all the reports and working with your lender or whatever. So all of that gets done. Now the legal part, the actual legal part that we do actually doesn't take a ton of time. What takes a lot of time is sometimes just having the client get us all the information or figure out how they want to structure it. But once the attorney gets all that information, usually it takes a couple of weeks to get all the documentation in place and all the disclaimer in place. And then, obviously, how long does it take to raise capital? It depends. Ken McElroy, which you mentioned earlier, will send out an email, and within a couple of hours, he's got $25 million in the bank.
Yeah.
You and I, it takes us a little bit longer to go raise the capital, but it all really does depend on how strong your relationships are within your community. How hard have you worked over the past decade to get to know people, establish those relationships, get that, know, like, and trust. And so some people, it takes them a long time. Some people, it takes them so long to raise the capital that they're, extending the closing deadlines or what have you. But the legal portion, actually, it's probably a 2 to 4 week process just from the legal standpoint to get to the point where you have all the disclosure documents, because the sponsor cannot start raising money until they have those documents. They at least can't start taking the monies until they have that document. So that document's kind of the gating item for a lot of sponsors. Like, hey, give me the document so that I can then send that out to my investors and I can start actually collecting capital, because, hey, I've got to close in the next 45 days. I'm under the gun here.
Yeah. It's it's a wild ride, because if you find a good deal, you need to be able to close quickly, which is why sometimes people do these blind funds. They want to already have the money so that when they find the deal, they can close. They, again, need to be experienced to do that.
Yeah. And by the way, that's one of the reasons, I know there's a lot of negatives of it, but that's one of the reasons blind funds have become popular, is because in a blind fund, the opposite happens. You actually raise the money first and then you go find the property. So you're not stressed in the sense that, hey, you find a deal, you've already got the money in the bank. And so that's one of the pros, if you can pull it off, of having a blind fund. Otherwise, it's you guys need to understand, it's a stressful process for the sponsors, because there's just a ticking time bomb in terms of a closing day that you need to get this money in. And there's no assurances of, where you are in the market, or how, you just don't know how the market's going to receive your particular business plan.
And your money goes hard, those deposits, you're going to lose.
And that money, that's the risk. That's a huge risk that the sponsor takes, because obviously the investors, if an investor, and this is not edged in stone, so you want to review your documents, but the common practice, certainly of all of my clients, including Kathy, is if you start investing money, if you send $100,000 to a sponsor to go do a deal, and the deal for whatever reason doesn't close, whether they change their mind or whatever, then you should be getting all of that money back. The risk of the earnest money deposit, the legal fees, all the stuff is really, really one of the reasons you're compensating the sponsor up front for some cash is that risk that they're taking on. And if the deal doesn't go out, to your point, you've put down a 3% earnest money deposit. That could be a big check that you're going to lose, for trying to pursue this deal that didn't turn out.
Yeah, that's why I like to. That's just too scary for me. And we had our turnkey, our rental fund in Texas, and that took so much stress away, because if we only raised a few $100,000 a week, then we would go buy a house a week. It was less stressful. But that money came in pretty quickly on the Texas fund, because the timing was so good. And the same with our current build to rent. It's like all we needed is enough to buy the land. We don't have to build all the duplexes at once. We can just build some of them and get them up and running and stabilized, instead of having to buy a whole apartment unit or something where you don't have that kind of flexibility. You've got to close on closing day.
Yep, I love it.
So how does a sponsor make their money? Generally, we talked about this. There's some ways that people are doing it ethically, and some ways people are maybe taking too much of a money grab.
Yeah, so there's a lot of different ways. There's basically monies that you earn. Most syndicators will make money in 3 phases. One is some money up front, right? So that might be something like in the form of an acquisition fee, right? So it's not uncommon for sponsors to charge usually about a 2% acquisition fee, meaning if I'm going to go buy a $3 million asset and I'm charging a 2% acquisition fee, then I'm going to get paid $60,000. I think that's the right number, $60,000 at the time we close on the property. So that's a little bit of money up front. Again, remember, the sponsors put in a lot of time with their due diligence and finding the property and getting the loan. I mean, there's a lot of work up front. So that's one way they get paid up front, with sort of an acquisition fee. Sometimes if they're also signing on the loan, or maybe some other people are signing on the loan, there might be sort of a loan guarantor fee in there, but there are some fees up front, right? Then there's the actual project itself. During the operations of the project, there's usually fees and cash flow splits with the investor. So typically there's an asset management fee. Again, you're managing the asset, you're overseeing the property manager. So it's not uncommon to see maybe a 2% asset management fee based on how much rents are coming in. And then usually you do get a split. The sponsors will take a split of the cash flow. So if rents are coming in, we pay the mortgage, we pay all of our expenses. And at the end of the quarter, there's X amount of dollars to distribute. Again, maybe 80% or 70, 80% goes to these investors, and the sponsors will take, the remaining 20 or 30% during the project. But then the bulk of it, the real compensation for the sponsors on the back end, when the project gets sold, or maybe if a refinance, well, usually refinance, there isn't a ton of money left over. But if you sell the project at the end, that's where sort of the money is for the sponsor, because they'll, number one, return all of the investors' money first. Then they'll pay whatever preferred returns they still owe, to the extent they owe any. And then whatever's left over, they'll split with the investor, 50-50, whatever, 80-40, whatever the split is. And that's usually where, if the sponsor's done a good job of adding value and creating opportunity, and you're able to sell the asset for more than you bought it for, there's going to be some profit. That's the chunk of profit you're taking. So that's the way you would typically see the fees. Now, I think what you're alluded to is, one of the things you cannot do, and you can do pretty much almost anything, but the not almost that you can do is, you cannot raise capital for the sponsors, right? And get a percentage of the cash, or a percentage of the deal, or a commission, or something like that, without a license. And I think that's something that's prevailing, especially these days, because it has been harder and harder to raise capital these days. Maybe not quite in a recession, but certainly from a multifamily standpoint, in real estate, we've been in a little bit of a recessionary period. So it's a little bit harder to raise money these days. And so it's very tempting for other people to say, hey, I've got a couple of investors over here. I can convince them to come into your deal. But in exchange for that, I want to get a percentage of whatever they invest, or I want a piece of the deal in exchange for me bringing that on. That's something that's a form of compensation that really is just it's really what I would call a disguised commission, in the sense that they don't have a license to raise money, so they're getting a commission, but they're not calling it a commission. Obviously, they're calling it something else. But so that would be kind of in the realm of fees that people are charging that really aren't quite up to par. But the other fees, the acquisition fees, the asset management fees, if it's a development deal, you'd see something. Usually, you would see a developer fee or a construction management fee. Depending on the asset class, you'll see different types of fees. But again, nobody's getting rich off fees. I guarantee you, the big money for the sponsors and the investors is on the back end of the deal when the deal's sold. If you've executed your business plan the way you drew it out, you're going to add a tremendous amount of value. Certainly on a development deal, obviously you're taking raw land and you're building all of these built to rent and all these amazing properties. The value you've added to that piece of property is extraordinary. And so that's really where sponsors get paid the most, but also where the investors get their big chunk of dough. You got to be super careful, because a lot of business plans will tell you, hey, your returns are going to be 15 to 20%. That's not cash flow. That's not every month or every quarter you're going to be getting 15 or 20%. Most of that is from the back end sale. You might be getting, most people, not yours, because you're getting such a high pref, but you might be getting 5, 6, 7, 8, 9%, quarter after quarter or year after year. But the bulk of it is really on the back end. That's what really LPs really want, is that most of them want that back end chunk of dough, 5 years from now.
Well, Mauricio, as usual, I learned so much from you. I hope our listeners did. I know that you said it's been hard to raise capital. I think that's partly because so many deals went south over the last few years. One of the worst times to invest in a syndication is during the frenzy. In 2022, there was just a big frenzy. Prices had peaked. There were lots of multiple offers. People were getting a little overzealous on their underwriting, and then interest rates went up. So it's been pretty tough for a lot of syndicators over the last few years. But now we're in a different environment. Why might right now be a better time to invest than, say, just a couple of years ago during that frenzy?
Well, just again, especially on the real estate side, I mean, Look, from peak, absolutely. Your peak was back in, I'm going to say 2021. Just from my own personal experience, I mean, running the law firm, we noticed a big drop off. It was, I think, second quarter of 2021. And from peak to trough, I mean, you've already seen probably a 20% drop in real estate prices, in some markets even longer. So the general view, the prevailing view is twofold. Number one, it's hard to argue, not impossible, but it's hard to argue that interest rates are even going to go higher. They've already, whatever run up on interest rates that happened over the years, you've probably, built most of those in. At this point moving forward, most people believe that they're either going to stay where they are or maybe come down a little bit, which obviously helps real estate. And then same thing with the price. I mean, we've already dropped, like I said, 20, 25, 30% in some markets. Can it drop further? Sure. But in the long term, real estate's a longer term play. Over the next 5 to 7 years, I think the odds are that, real estate is going to be coming out of that sort of recessionary period, and we're starting that new cycle. Now, we still have a lot of inventory that needs to be cleared. There's still a lot of these operators that you mentioned that are in trouble, that really should be selling or should be getting out at losses, which again creates opportunities for other people to come in and buy those at an attractive rate. But banks are still a little bit hesitant to, foreclose or really put the screws on the operator. So they're kind of kicking the can down the road. And, we thought this was all going to get cleared out really this year in 2025. But some of the lenders, I've spoken to a lot of the brokers, a lot of lenders are trying to accommodate, modify, kind of push this thing down the road. But once we get this thing cleared, which will happen here in the next, year, maybe even 18 months, you should see real estate then keep going. Not to mention, if you look at you know this better than I do, Kathy, if you look at permits being pulled and construction coming up online, you're going to see that there's a big gap here. People aren't building because after the frothiness and people getting excited, builders don't build. And so now we've got this period where in a couple of years anyway, you're going to see all this demand still going to be there, but there's not enough inventory because people, as of right now, the builders have not been building over the last couple of years.
That's why we're so excited about the build to rent. We at Real Wealth, we help individual investors build their individual portfolios, and we have got teams across the country to help them do that with property management in place. But really, we're in the selling real estate business, and great for our investors, they get the upside. They buy a property, over time that property goes up in value. But in this particular area in San Antonio, it is the top 10 fastest growing zip code in the country. So I went to our partner there and just said, do you really want to be selling these off, or do you want to build them and hold them? Right. When we know that this area is just booming and there's not a lot of competition for the reasons you said. It's a lot of build to rent communities stopped because they had too high of overhead. They couldn't make the numbers work. We're little and we can make it work. He's built these many times. He knows how to do it. He's got teams in place. So that's why we moved forward with this, even for all the reasons you just said. When these come online, there's just not going to be a lot of competition. So we underwrote it so conservatively. We think we're going to do far better than what we put in the pro forma. So if you want more information on that, just go to realwealth.com/Wild Pine. You do need to be accredited for this project. I'm sorry, again, that's $200,000 income, $300,000 if you're married, or $1 million net worth, or you have a securities license, and talk to an attorney to make sure. All right, Mauricio, so happy to have you here with us on the Real Wealth Show. It's always a pleasure. I always learn so much.
Always great to see you, Kathy. Thanks for having me on again.
Again, if you want to learn more about our syndication in San Antonio, Texas, it is a build to rent community. We're building 56 duplexes with a builder that we've worked with at Real Wealth for years. He's actually our most popular property team. We're offering a 12% preferred return. The timeline is about 5 to 6 years to get them built, leased, and stabilized. We expect either an institutional investor to come and buy it, or we can sell it to Real Wealth members who might want an occupied new investment. For more information, just go to realwealth.com/Wild Pine. Also, if you want to learn more about syndications, Mauricio is going to be doing a webinar with us at Real Wealth. That'll be on March 12th at 5 p.m. And it's free to join that webinar. Just go to realwealthshow.com, click on the join button. Again, it's free to join and free to attend the webinar. I'm Kathy Fettke. Thanks for joining me here on the Real Wealth Show, and we'll see you next time.
views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.